Hello, everyone, and welcome to Finability's virtual workshop. Today, we're talking about credit and debt. This is part of a five-part workshop series we designed in partnership with Financial Beginnings, focused on reclaiming your finances and thriving. I'm Jolene, the Director of Programs at Finability, and I'm here today with Stan, the instructor of our workshop, and I'll let Stan introduce himself.
Thanks, Jolene. I am a retired business executive from the technology world and am a longtime volunteer with Financial Beginnings and a member of their board.
Finability is a 501c3 nonprofit with the mission to create financial pathways to safety and joy because we believe every survivor of domestic abuse deserves the opportunity to thrive. So we work to provide the financial tools, mentorship, and support to make that possible. We are an organization by survivors for survivors, and we were founded in response to the reality that 99% of survivors experience financial abuse. Because of that, we know that this information we're sharing today and throughout our workshop series may land differently for each of you. Some folks may feel affirmed or empowered, while others may feel overwhelmed, activated, or reminded of painful experiences. And all those reactions are valid. This is just a reminder to please take care of yourself in whatever way you need as you go through the workshop. Today, we are talking about credit and debt, and we want to acknowledge that many survivors experience debt and damage credit, sometimes because of a harm doer or ex-partner, and sometimes because of the difficult choices required to reach safety. The term coerced debt refers to credit-related transactions that are non-consensual and occur within an abusive relationship as part of the harm a person experiences. Coerced debt can include anything fraudulent, coercive, or manipulative. And organizations like the Center for Survivor Agency and Justice are working hard to advocate for policy changes that will help future survivors navigate and resolve this kind of financial abuse. And finally, before I hand things over to Stan, I want to acknowledge that economic safety and physical safety often go hand in hand. So for many, having a low credit score or debt can make safety even harder to obtain. Our hope with this series is to offer practical tools and information so more survivors can feel empowered, knowledgeable, and supported as they move toward thriving. With that, I will hand it over to you, Stan.
Great. Thanks, Stacy. As Stacy mentioned, we're talking about credit and debt. So let's start with understanding credit. What is credit and why is it important? Well, credit is one measure of one's ability to repay debts. It's used oftentimes by people who are lending to determine the likelihood of them being repaid. And so, because of that, your past credit activity is amalgamated into a credit report and a credit score that we'll go into in a little more detail. Now, in addition to using your credit score and your credit report when you're buying something on credit, your credit is also checked and used in other areas, like getting a phone service or renting an apartment. Now, why would somebody check your credit on renting an apartment? Well, the credit scores operate under the philosophy that your past history is the best indicator of your future potential performance. And so they're looking at how well you've handled money in the past to see how likely you are to make rent payments on time. This is also true when getting insurance. More and more in the last few years, insurance companies are checking their insureds, their customers' credit to determine how well they've handled their finances in the past and see how well they're going to handle your finances in the future or how well you're going to manage handling a car. And so credit insurance agencies utilize your credit score to set, in part, your insurance rates. Now, that's a little clue. I'm going to step out of the normal credit discussion and just give you a hint that says, if you've improved your credit over the last year and you've had a clean driving record, we'd recommend you talk to your insurance agent and ask for an insurance review. That's code speak to the insurance company that says, I want to evaluate my insurance rates, my premiums. And if I've had good credit or improving credit and a good driving record, oftentimes you will be able to lower your insurance rate. So just keep that in mind as another reason why you want to improve your credit. Now, when you look at improving your credit, you have a credit score. Okay, and this score will run from 300 at the bottom to 850, which is perfect. And generally nobody has either 300 or 850. You're somewhere in between on the spectrum. And so when you look at this and say, okay, where am I today? The important thing is to think about where can I be tomorrow? How do I improve my credit score? And to do that, to improve your credit score, you need to know what goes into making up your credit score. And so that is these five factors that go into making your credit score. The first and most important is your payment history. That's how often do you make on-time payments to all of the outstanding debts that are reported to the credit bureau. Um, Critical when you have any kind of a loan or obligation outstanding is to make sure the payment is made on time. Because as you can see, this makes up 35% of your credit score. It's the largest single factor in determining your credit score. So make your payments on time. And when you're making your payments on time, make sure you realize that the payment needs to arrive at whomever you're making that payment to, not get it in the mail or start the transaction. So if I'm mailing a payment and it's due on the 15th and I mail it on the 14th, I'm probably going to be late. And that on-time performance or late performance gets reported to the credit bureaus, and that gets factored into your credit score. The second largest component is the balance to limit ratio. And this is a ratio of how much credit you have approved and how much of that credit you're using or your balance. So if you have a $1,000 credit card and you have a $300 balance, your balance to limit ratio is 30%. And that's good. You want to keep it at 30% or below. As you get above 30%, your credit score starts to go down. And so if you have a $1,000 credit limit on a credit card and you've got $900 balance, that's going to negatively impact your credit score. So, and now that's true for all of your credit. So when you look at your credit report, if you have more than one area, a company, organization that's giving you credit, they're going to total all of the limits. So if you've got three credit cards at 1,000 each, they're going to your limit is $3,000, and then they'll take the balances on those three and sum those, and then do the ratio. So keep your balances below, ideally at least below 50% of your credit limit, ideally closer to 30%. The other three factors have less influence. Length of history, how long have you had credit? They're just looking for experience factor there. Your mix of credit, do you have different kinds of credit? Do you have a mortgage loan, a personal loan, a credit card, student loans? And so the mix of credit will help. Having a mix of credit will help your credit score. And then new credit. New credit will impact your credit score, particularly if you've just taken out new credit. It may actually decrease your credit score for a short period of time. So those are all the factors that go into your credit score. Now, your credit score is going to determine the cost of future borrowing. And so if you have negative events that reduce your credit score, that's going to increase your cost of borrowing. This is an example of some of the negative events that may happen. If, let's say, you max out a credit card, well, that could be a 25 to 45 point reduction in your credit score. A late payment can be a reduction. Debt settlement. Bankruptcy is a huge hit to your credit score. So just know that as you max out your credit card and make a 30-day late payment, that could be 30 plus maybe 130 point negative impact to your credit score. Well, and we'll talk about how that will impact your credit in a moment. Now, you can monitor your credit at the different credit bureaus. There are three credit bureaus in the US: Experian, Equifax, and TransUnion. And at each of those, you're going to have a sample credit report that'll have your personal information, account history, public records like judgments or liens, and inquiries, other credit inquiries that have been made. So like if you're applying for new credit. And because not every lender reports to every credit bureau, you should check all three credit bureaus periodically. If you go to www.annualcreditreport.com, you can receive a free credit report from each of these agencies once a year. And I will caution you, go to this URL directly, annualcreditreport.com, because if you Google free credit report, you're going to get some sites that may look like that are going to be charging for that credit report, and you don't have to. So let's say now you want to establish credit. You want to establish better credit. Well, there are a couple of different ways to do that. First is if you're a student and can get a student credit card, it may be a lower limit, but a little easier to get approved for. Or if you have bad credit and have applied for a credit card and been denied, you can apply for a secured credit card. What a secured credit card is a credit card that's secured by a deposit of money that you've made with that institution. So I'll go to my bank or credit union and say, I'd like a secured credit card. They'll say, fine, deposit $300 with us. It's your money, but we're going to put it in a separate account that you don't have access to. And then we'll give you a credit card with a limit of $300 or $500. Because it's secured by that deposit, if I don't make the payments, they're going to take that deposit. Use that credit card for a year, making payments on time, paying it off every month if you can. And then after you've done that for a year, go back to your bank or credit union and ask to have a regular credit card and get your security deposit back. So that's one way to build your credit over time. You can also become an authorized user or obtain a cosigner. When my kids went to college, I was a cosigner on a credit card for them. A cosigner, in essence, guarantees that if the person that took out the credit card doesn't make the payments, I will. And so it'll get reported on both of our credit reports. And then if you're renting, go to your landlord or your property manager and see if they'll report rent and your utility companies, if they'll report them to your credit bureau, because presumably you're making those on time every month. And that's also a demonstration of responsibility in handling your finances. So those are three different ideas on how you can establish credit. So credit is a measurement of your ability to borrow. So let's talk about how that comes into play in terms of your cost of borrowing. So remember earlier, I used that example of I maxed out a credit card and I was 30 days late and I got 130 point potential negative to my credit score. So let's assume I'm applying for a $10,000 car loan over 4 years, and my credit score is in the 780 to 850 range. Well, my APR, annual percentage rate, or my interest rate that I'm being charged is 4%. And in this case, that payment would be $225. And over the 4 years, I'll pay $837 in interest. But if I did that 130 point hit, now my score's gone from 780 down to 650. I'm now in this category, paying 8%, double the interest rate. Okay, my payments have gone up a little bit, but over the life of that loan, I'm going to pay double the amount of interest. So those two mistakes right before I applied for a car loan could end up costing me an additional $800 on the price of that car. That's why it's important to make your payments on time. That's why it's important to know what your credit limit is and don't max out your credit card. Now, another aspect to look at is the cost of borrowing by term. Term is the length of loan that you're taking out. And so you can have a shorter loan or a longer loan. A shorter term, you'll have higher payments, lower interest rate, and lower total interest. And the converse is true in a longer loan. So let's use that same $10,000 example. If I take out that loan over 24 months or 2 years, I'm going to make $452 payments and pay $855 in interest. But if I stretch that out to 6 years, my payment went way down, but I'm paying more than 3 times the amount of interest. And so the moral of that story is that you want to take out the shortest term uh, of which payments you can afford. So just keep that in mind when you're applying for credit. Also know that when you make a payment, the interest and the principal's the actual amount that you borrowed, they're calculated differently early in the loan versus late in the loan. You're paying a lot more interest in year one than you are in year six. And that's because the company that issued that loan wants to get paid up front, and they make their money off of the interest. Let's talk a little bit about credit cards. So how do I choose a credit card? Um, what a lot of people do is they go down and look at the rewards and benefits. I'm going to go get a mileage card. We'll talk about some of the rewards and benefits in a minute. Um, and then they look at interest rates. What I recommend is look at the fees first. Credit card companies make their money 3 different ways. One, they charge their cardholders an annual fee. Two, they charge the stores or the companies you do business with a fee. And three, they charge us interest when we carry a balance. So the first thing I would look at is I would look at the fees and get the lowest fee. If you can get a 0 annual fee credit card, I would go with that first, and then look at the annual fee that's being charged. Then you can look at interest rates. Now, if you're not carrying a balance each month, if you pay off your credit card every month in full, you're not going to be charged any interest. So the interest rate really doesn't matter. But if you do have to carry a balance, then look at the interest rate and make sure it's an affordable interest rate. And early interest rates, if you're in the 16 to 18, 19% range, that's good for a credit card. You can get up, if you have worse credit, you can get up into a much higher interest rate. Now, when you look at rewards and benefits, there are a variety of things to look for. One is cash back. The credit card companies they're trying to incentivize you to use their card because they're charging whoever you use the card with a fee on that transaction. So they're going to give you cash back. The Costco card, for example, I know gives 1% on general purposes and 3% on gas purchased at Costco. So cash back is one category of card. Travel, the miles card we've all heard about, is another. Stores may offer their own credit card. We mentioned student and secured credit cards. Now, I'm not a big fan of travel credit cards because they usually come with a bit large annual fee, and you've got to spend a lot of money to get enough miles to buy an airplane ticket. So I personally would rather do the cash back, and I'll take the cash back they give me, put that in a travel account, and I'll use that for my free ticket. Now, when we look at debt in total, the question that we're asking ourselves is debt good? Sorry, is debt good or is debt bad? And the answer is yes, it can be either. Let's look at some examples here. One of the things we want to look at is, can you leverage the debt? And using a lever allows me to lift something heavier than I might normally be able to. Well, leveraging debt allows me to reach for something that I might not be able to reach for without that debt. So a mortgage is a great example. I could take out a mortgage and buy a house. I probably can't buy a house for cash. I know I couldn't when I was younger. And so I'm not going to buy a house if I can't take out a mortgage. So that's debt, but that's good debt. It allows me to purchase something. It's my own. I can make improvements and I can build equity because often if you buy right, real estate can increase in value. Student loans, if you're taking out a student loan to improve your earning power, that can be good debt. Okay. You just want to be careful. There is one caveat there is that you want to limit the amount of student loan you're taking out relative to the job you're going to get when you graduate. So there are websites you can look and say, I'm studying to be a social worker and it's going to cost me $40,000 to get this degree that allows me to be a social worker. What was the social worker make when they first get out of school? And you'll find, and it may be that they make about $40,000. So that's good. You want to graduate with no more student loan debt than what you're going to make in your first year in that new profession. Now it's all estimate, right? You're not going to be exact, but look at it. But if it's going to take you $80,000 because you're going to a private school to get a degree for a job that I'm going to make 40,000, that's now bordering on the bad debt. That's too much student loans. Auto loans depends. Just make sure that you can afford the payments and that you're not underwater. That particularly when buying a used car, that your loan isn't more than the value of the car. Personal loans, same thing. It just depends on what you're using it for and how quickly you're going to pay it off. Credit cards, if you can pay it off every month, that's great. Okay. And it's a great way to build credit. It's a great way to access things before your next pay period. But just make sure that you're not building a balance and carrying a balance every month. I recently ran into an individual. I do some financial coaching, and this individual took a credit card and maxed it out, and then just opened a new credit card and then maxed it out, and then opened a new credit card and maxed it out. And so they ended up with 3 credit cards, making minimum payments on all and not making progress. So just make sure you build the payments and paying off what you put on your credit card into your budget, and it's good debt. Payday loans and cash advances are not good loans. That's not good debt. I'm taking out a loan until payday because I can't I need to cover some expenses until then. However, when payday comes, the first deduction is that loan. And so I'm now behind the 8 ball again. So I try and stay away from payday loans and cash advances. All right, let's assume we have this debt. Let's talk about repayment. I started talking about minimum payments, particularly on credit cards. If you only make the minimum payment, it's going to take you much longer to pay off that debt. This is an example. Assume you have a balance of $2,500 at 18% on a credit card. And if you make a $200 monthly payment, then you are going to pay that loan off in 1.2 years. But if you're only making the minimum payment, then over the life of that loan, when you pay it off in 8.9 or 9 years for the same $2,500, you're going to pay $1,300 in interest. So from almost $300 to over almost $1,400 in interest, an additional $1,100 in interest that you're going to pay on that loan just because you're making minimum payments. So if you're in that situation, we have a couple of strategies for you to employ. The first strategy is called the snowball method. In the snowball method, you list all of your loans, the balance, the minimum monthly payment, and make sure you're making the minimum monthly payment. Okay. So $430, $480, right? Then look at, can I add any incremental? So let's say I'm adding $10 incremental to my smallest balance. So the snowball method says, find extra money and apply it to your smallest balance to get it paid off. Once you pay it off, that $60 a month you were making on that loan, you apply to the next smallest balance. And so now your payment's even larger. So you're always making that same payment, that $490 payment, but you're just moving the money. Once you get a loan paid off, you keep making the same payment to the next debt. And so by paying off the smallest balance first, the next smallest second, you build momentum. And so that's like a snowball rolling down a hill. Now, you can also use the avalanche method. And the avalanche does the same thing. You line up all your debts, you look at your balances, but you look at the interest rate and you make that extra payment on the highest interest rate first. So in this case, the smallest one also happened to be the highest interest rate at 22%. So I made that $60 payment on My smallest balance got it paid off, then moved it to my next smallest, I'm sorry, smallest interest rate, moved it to my next smallest interest rate, and on down the list. Okay. Either method will work. If you have a loan with a very high interest rate, say like above the 22%, if you're 30% or above, then I would use the avalanche method. Otherwise, you can use the snowball method. The third is to use debt consolidation. This is where you take all of your loans, lump them together, take out one other loan that will pay them all off, and then make that payment. And so in this example, you can see there's actually a $76 monthly savings by lumping them all together at a lower interest rate for the whole debt. The caution there is if you do a debt consolidation, don't go back and be putting balances back on that credit card because now you're just kicking the can down the road. You're not making progress. As you borrow, you have certain responsibilities. Okay. Borrow only what you can repay. Read and understand the credit contract. I'll give you an example there. One of the ways you can get credit is, let's say you need a new refrigerator, and you go down to Home Depot or Lowe's, and they will offer you a refrigerator 12 months or 18 months, same as cash. Okay. So even though you may have the cash available, you say, I'll pay this off in 12 months and not impacting my budget quite as much and keep my savings in place. So I'll make these monthly payments. Now it is same as cash. They're charging zero interest as long as the debt is paid off by the end of the 12th month. But if it's not, they're going to charge you interest back to the beginning of the contract. And so now you're going to have interest charged on the whole thing. Now that's in the agreement. So make sure you read and understand the agreement. If they're offering you 12 months, same as cash, ask them what happens if I'm late on the last payment. Pay your debts promptly. Most importantly, if you run into a problem, and we all have, notify your creditors if you can't make the payment. Okay. They have heard every story. They've seen all the circumstances that everybody's run into. Nothing surprises them. And they will work with you if you want to work with them. If you tell them, I want to work with you. The same thing's true if you lose or have a credit card stolen. Report it as soon as possible. Now, if I still can't pay after contacting the creditor or the lender, I may want to seek credit counseling to understand how. And one of the things you may want to evaluate is looking at Finability's mentoring program. That may be an option for you. But if that still doesn't work, one option is to do a bankruptcy. Now, bankruptcy, you go to court and you say, I can't cover these debts and I'm not going to be able to. And so some of those debts will be erased. Those creditors are going to be told, this person has filed bankruptcy and you're not going to be paid. It's a huge hit to your credit report. It's not free. It costs money to file bankruptcy because you have to hire a lawyer, you have to go to court, you have to pay fees. But if that's your only option after consulting a lawyer, then you can go through that process. But I'd use it as only the last resort. You also need to keep in mind there are certain debts that never go away, even in a bankruptcy. If you owe back taxes, you're going to need to pay those back taxes. Now, if you owe the federal government taxes, oftentimes you can work out a payment plan with them, but only if you contact them and say, I'm having difficulty, I've lost my job, I've run into a certain circumstance, and I'd like to work out a payment plan. If you owe back child support or alimony, which is today called spousal support, then you've got to pay that as well. Filing a bankruptcy will not eliminate those debts. You've got to pay them. And then student loans. This is why we recommend really watching the amount of student loan debt you take out relative to the job you're going to get, is because you can't discharge a student loan in a bankruptcy. So you have that, you're going to pay it off. So let's step back and say, when we look at credit and debt, what are some best practices? Well, we haven't really talked about it in this module. We talk about it in another module, but one of the things we recommend is create an emergency fund. This is savings that you've set aside for an emergency. Start with $500. See if you can get $500 into an emergency fund, because if you have that car accident, need to come up with a deductible it's generally $500, and you don't want to put that on a credit card if you don't have to. So by having an emergency fund, start at $500, build it to 1,000, and then if you can, build it to 3 to 6 months worth of expenses. Because the biggest emergency you may run into is an inability to work, or losing your job, or something that impacts your earnings or your ability to earn. And so if you've got expenses covered, you're less likely to go into debt. Second, from a savings standpoint, if your company offers a 401k, enroll in it if you're not already. If you put 2 to 3% of your income into a 401k, a tax-deferred retirement account, your take-home pay will actually be about the same as it was before you did that, because you're reducing the amount of tax you owe. And we'll go into that more on our one of our other modules. Then start that emergency fund, reduce your debt, figure out which debt payoff strategy you're going to use, and get those credit cards, get those personal loans, get those student loans paid off. And you can do this while investing in your 401k, but that should be the next step: is get your emergency fund, get your debt paid off, and then concurrent with all that, go ahead and invest in your 401k. If you start down that path, you'll make tremendous progress. We've seen this in a variety of situations.
Thank you so much, Stan. I truly do write something down every time we do these workshops together, so I really appreciate it myself. So we want to make sure to leave you with a few resources. The first is the National Network to End Domestic Violence. They have a program for microlending and credit building, especially for survivors. They, excuse me, you can go to their website, nnedv.org, to learn more about that. Also, Free From, they are a partner organization that's similar to what we do here at Finability. So they support survivors with economic and financial empowerment tools. So they have great resources, both online and programs. So check them out at freefrom.org. And then if you want to find local support, so maybe your local domestic violence organization, the best way to find your local or nearby domestic violence organization is to contact the hotline. They're a national organization, and they have connections to and resources all across the country, and can connect you to their resources. And then, of course, sometimes this information can feel overwhelming, and we want to encourage you to celebrate the small milestones. And this can look different for everybody, but some ways to acknowledge what you've already done might include recognizing the courage that it takes to make financial decisions, especially after experiencing a situation where control was taken away. Honoring the steps that you can't see, so things like setting boundaries, asking questions, or learning something new, or saying no to something that drains you. Celebrating consistency over perfection. So knowing that perfection is not the goal, but showing up for yourself is. Also acknowledging the emotional wins. So things like feeling more confident or calm or more clear about what you want and need. And then giving yourself credit for rebuilding at your own pace. Healing from financial abuse happens step by step. If you want to learn more about what we do at Finability, please visit our website, finability.org. We also have a page where you can contact us. If you have any questions or thoughts or feedback, we'd love to hear from you. And finally, thank you so much, Stan, for helping us teach these workshops. Thank you so much to Financial Beginnings for being a great partner in this. And we appreciate everyone for being here today, and I hope everyone has a wonderful rest of their day.